Have you ever wondered what would happen if the price of the US dollar was fixed against the Indian rupee? Imagine living in a world where $1 always equals 75 rupees, no matter what happens globally. It might sound stable, but there's much more to the story. In this video, we'll explore 1. How a fixed exchange rate works. 2. Its advantages and disadvantages. 3. Why countries prefer floating or managed exchange rates. What is a fixed exchange rate? A fixed exchange rate means the value of the US dollar is tied to the Indian rupee. Let's say at $1 equals 75 rupees. This rate doesn't change, no matter what's happening globally. For this to work, India's central bank, the RBI, must intervene in the currency market to maintain the fixed value. Let's look at the advantages of a fixed exchange rate. Number 1. Stability for trade and investments. Businesses know exactly how much they'll pay or earn. For example, an Indian exporter shipping IT services to the US won't worry about dollar price fluctuations. They'll always receive 75 rupees per dollar. This predictability attracts foreign investors. Number 2. Control inflation. A fixed rate prevents the rupee from depreciating too much, helping India control import costs like oil and machinery. Number 3. Promotes confidence. Global investors feel more secure investing in India, knowing the rupee's value won't change overnight. But here's the catch. Disadvantages of a fixed exchange rate. Number 1. Pressure on reserves. To maintain $1 equals 75 rupees, the RBI must buy or sell dollars in the market. For example, if there's high demand for dollars, the RBI sells from its reserves. Over time, these reserves can drain, leading to economic instability. Number 2. Imported inflation. A weaker global dollar can lead to higher prices for imported goods. Imagine India importing oil from the Middle East. If the dollar's global value weakens, oil becomes more expensive, causing inflation in India. Number 3. Trade deficit. Worsens. Fixed rates make Indian exports less competitive globally. Now, let's talk about the Tiffin Dilemma, a major problem in fixed systems. The US dollar is the world's reserve currency. To support global trade, the US must supply enough dollars to other countries. But here's the dilemma. More dollars in circulation globally weakens the dollar's value. But if the US stops supplying dollars, the global economy faces a shortage, leading to instability. India, in a fixed system, would depend heavily on the dollar's global stability. Any weakness in the dollar could trigger inflation and trade deficits in India. Now, comparing with a floating exchange rate. Many countries use floating exchange rate system. In a floating exchange rate system, the value of the rupee adjusts naturally based on supply and demand. Advantages of a floating rate. The RBI doesn't need to maintain reserves. Indian exports become competitive during rupee depreciation. But it has disadvantages too. Uncertainty for traders and investors. Vulnerability to speculative attacks on the currency. Despite disadvantages, why countries choose a floating or managed exchange rate? The reason is simple. To balance stability and flexibility, many countries choose a managed exchange rate. Here's how it works. The currency is allowed to fluctuate within a certain range. The central bank intervenes only when the exchange rate crosses these limits. For example, India follows a managed float. If the rupee depreciates too much, the RBI steps in to stabilize it, but otherwise, the market determines the rate. So, what if the dollar was fixed to the rupee? It might bring stability, but it comes with major risks like inflation, reserve pressure, and dependence on the US economy. Floating or managed rates offer flexibility, though they require careful management. That's why countries adapt their exchange rate policies based on their economic priorities. What do you think? Should India fix the rupee-dollar rate? Let us know in the comments below. Don't forget to like, share, and subscribe for more in-depth videos.